All right, so I think I'm going. All right, so this is the February 2021 portfolio update. Right away, we see that we have a sales signal for Best Buy. We're up a little over 10% in that position. Um, it's only been a month, so I think we'll hold out a little bit longer just to see what happens. There hasn't been an earnings report yet for fourth quarter 2020, so I'll look at the date on that to see, what may happen during the earnings or shortly before earnings. Usually that has some effect on price. So if the earnings call is not happening until later in the month, then I'll put off doing any sort of analysis on Best Buy until March. Rogers Communication has been a long time holding for us. We just added to our position a couple months ago. If you see the commissions here, these are not really commissions. That's actually foreign tax because this is a Canadian company. So every time we receive dividends from this company, we have to pay a little bit of foreign tax on that. And so that's what you see there is the tax. But this has been a long-term holding for us, and we've been slowly adding to it. You see here we're currently down about 5% in this position, but it's a decent company, and they're doing really well. Of course, the sports not being up and going is a big deal for them because that's where they get a lot of their ad revenue. The Toronto Raptors are playing again. The NHL team that they own, Toronto Blue Jays, no, Toronto Maple Leafs, I think, something like that. But anyway, they own sports franchises, right? So the basketball team is going again. The hockey team is playing only Canadian teams, and then the baseball team, the Toronto Blue Jays, they are not playing at all right now, and there's questions about whether or not they're going to be playing in the stadium. So we're talking about a loss of ticket sales. We're talking about a loss of ad revenue, being able to advertise to the people at the stadium, but also people watching at home as well. So I think they're in a really good position, though. They're the leader in Canada in 5G. They're the leader in iPhone users in Canada. They are the first to have 5G, and I think they have the largest coverage of 5G in Canada. So they're doing well. Their turnover is still really low. There's not a lot of people leaving. They're steadily increasing their Insight TV package, which I'm not really excited about, honestly. They're not adding huge numbers of customers, but they aren't losing a lot either. They did offer lots of discounts and discounts on phones in the past year due to COVID, so that is starting to turn around a little bit. They still have store closures in Canada because of COVID. So I see nothing but upside from here. We did an analysis last month, I believe, amongst the other competitors, and Rogers, is a better deal. So we're going to stick with them. If we get a chance to add more to the position, we will, because I would love to have 100 shares of this thing so we can get into trading some options as well. All right, Excel Energy. This is a new holding for us, but we've invested in Excel Energy in years past, so we're kind of coming back to Excel Energy. They are really interesting in the fact that they have said over and over again that their biggest driver is zero emissions. Well, not zero emissions, I'm sorry, clean energy. Clean energy. They've always, for all the years I've been following them, have had this, they call it steel for fuel. Which means that they're building these wind projects in order to generate electricity. And so that means that they're buying steel, they're building the windmills and generating electricity. And they've been doing that, for the last 5 years at least, and they're continuing to do that. Their goal is to be completely free of coal by 2050. They do have nuclear But wind is really their biggest driver and where they're really going. It's a great company, has always done well for us, and I'm looking forward to continuing to see their success not only as a company but also in share price as well. I ought to mention as well that they did increase their dividend this quarter, so that's really good. I think this is the 17th straight year that they've done so. It's also important to note that again, it's a utility, so their revenue is regulated by the government, and so they are requesting a revenue increase in, I believe it's South Dakota or North Dakota. I forget which Dakota it is, but they're requesting a revenue increase there. First increase that they've requested in the last 8 years. So we look forward to having that bump up in revenue. And they're consistently, requesting more money in the other states that they provide services, Texas and Minnesota being one of them. All right, Valero. Their earnings call just finished, and they are, and again, this is a new holding for us. We we sold a put in order to get into this position. So we sold a put at 59.50. The price made it all the way down to 56 and change, and so we were called on our put position, and now we own 100 shares. As you can see, we have 100 shares, and we currently have a short call position to sell these 100 shares at $67, and that expires on March 26th. Okay, so just to make sure we and clarify here, we sold a put at roughly 100 and I think $30, $140, something like that, last month to buy this thing at $59.50. So we made that money, and then we actually had to buy the stock because it did go below that price. And now we have sold a call position to sell this stock at $67, which will be a $700 profit for us. But we also get to keep the option premium of $135, I think it was. So all in all, if we do end up selling this thing at $67 before March 26th, we will have profited somewhere in the neighborhood of $1,000. I don't know if it's going to go there right now. You see, we're actually up about 3% in our position. The price is somewhere around $61. So we'll monitor that and continue to sell those options to increase our profit on this holding, as well as, of course, the great dividend that they pay. Now, Valero, like many energy companies, has seen some losses because of the whole COVID thing. There's also a problem with the difference between oil price and gasoline prices, which is really slim right now, right? This is a gasoline company primarily, so they make a lot of money when oil is cheap, but gasoline is high, okay? And right now, oil is cheap and gasoline is cheap as well. So they aren't able to turn a huge profit on that. The one thing that they discussed quite a bit in their earnings call is their recyclable diesel fuel, which is something that they are really going hard with. And this kind of goes back to the Excel Energy conversation as well, which is everything is moving towards this green energy, this clean energy. And so Valero is really keen on getting that done. They are the nation's leading recyclable diesel manufacturer. A lot of their gasoline is going over the border to Mexico, and they're building refineries in South Texas to make that happen, to make it easier, rather, to get the gas down there. So all in all, they're doing good. Once the economy comes back, we'll definitely see some increases, I'm sure, in the price of gasoline. I don't expect oil to move very much. I think we're kind of in that environment where oil is just going to be where it is, unless something major happens. The technology on drilling oil has increased exponentially, I think, over the years, and so the oil prices just keep getting cheaper and cheaper. I can imagine because of all the cutbacks, because of all the drills that aren't going right now, because the demand is so low, that at some point, when demand starts to grow, there's going to be something of a catch up, right? Where there's going to be a jump up in oil prices, and possibly a jump in gasoline prices as well. So again, I see nothing but upside from here. I can't imagine there being anything to drive this industry further down than where it has been. So again, new position for us. So far, so good. We're currently up in our position, and we look forward to selling some more options against it. All right, Campbell Soup. We are currently down about 2% on Campbell Soup. This is a consumer defensive company, which means that it's a stable, right? And the price is going to be that as well. It's going to be stable. It's going to pay a decent dividend, but we don't expect any surprises from this company, honestly. They did speak to revamping their NFL advertisement with Campbell Soup to try to drive that. They're really talking a lot about their snacks. I actually learned quite a bit about the company. I didn't know that they own Cheez-Its and a lot of other potato chip brands that I had no idea about. So the snacks is really going to be their driver, where they can really make some money here and get into new markets. The canned soups and whatnot are going to be what they are. I don't expect that to change very much if they can, get this NFL thing revamped and get going again. Then I think they will be they'll have a bright future. They also discussed getting out of traditional marketing and getting more into the digital space, the TikToks and the Snapchats and the Facebooks and whatnot. I don't know if I've ever seen a social media ad from Campbell Soup, but I mean, it makes sense. It's a good place for them to be because it is one of those like heartwarming, cold day type of thing where I can really see that happening. Not to mention we're having a really cold winter, so I'll be really surprised to see what happens on their first quarter earnings call in a couple months. All right, Merck. Merck, we are currently down right now in Merck, which is surprising, but it's not surprising. I have to be honest with you, I did not enjoy their earnings call at all. Their biggest prescription drug right now is Keytruda, which is doing really well. At some point, they will lose the patent on Keytruda, and they don't have any other flagship brand prescription drug to take its place. And so that's a big deal. But they don't have the same issues that some of the other drug makers like Pfizer have. They completely got out of the COVID game, which I'm happy about, honestly. And they're focusing just on their immunology prescription medicines. Immunology. I can't say that. Immunology prescription medicines. Cancer, that's their driver. That's where they're going to make their money. They did talk about, not wanting to do deals with smaller prescription drug companies because a lot of times that's what the big guys do. You have these smaller laboratories that come up with these drugs. They're in, second phase, third phase, awaiting FDA approval, and the big guys go in there and buy them up. And Pfizer, I'm sorry, but Merck stated that that's not something that they're looking to do. So that means that they're going to be stuck or mired in their own pipeline for a while, and they are working to keep Keytruda going out of patent, and they're doing that by basically remixing it and coming up with these different, what's the word I'm looking for? Different different variants of the same drug to make it better and like I said to keep their patent on it. So that's kind of what they're betting on right now. They do have a portion of their company that they're turning out. Honestly, I'm going to have to look more into the company, but it's called Argonon, something similar to that. Argonon is going to pay them a one-time dividend of something like $8 billion once they turn this thing out next quarter, and then it's going to continually pay them a yearly dividend after that. So they're looking at possibly giving a special dividend to their shareholders. So we have that to look forward to in the next quarter or two, and really seeing what that's going to do for their bottom line going forward. They did mention, slowdowns in some of their prescription drugs because of COVID, of course. But again, I see nothing but upside from that as doctors' offices continue to open and allow patients to walk in without many restrictions. All right, Fastenal. One thing I want to mention here, Fastenal, as you can see, this. Where's my mouse? Here you go. This column right here is the amount that we are over or under allocated. Okay, and you can see that here as well, where the software is calling us to have 29 shares of Fastenal, and we only have 20. Okay, so what that means is that we are under allocated $457. I think that's important to note here. Fastenal, we are down in Fastenal. This is, nails and fasteners company, okay, industrial company. They sell to lots of manufacturers and big businesses needing, tools and nails and screws and whatnot. Their biggest driver right now is going to be their safety equipment. Because of course, due to the COVID pandemic, the PPE is what they call it, is really in demand, and so that's their biggest driver. That's what they're focusing on. Their biggest achievement right now, honestly, is their new vending technology that they actually purchased a company in order to get. And so the vending technology basically alerts Fastenal that their customer is out of or is running low on some supply of some part. Okay, and then what that's going to do is that's going to automatically signal a purchase order to Fastenal. Fastenal is going to deliver on that purchase order, and then Fastenal is going to get paid later. So they're saying that this new technology is going to really help reduce cost and possibly increase revenue. But again, I don't expect anything huge from these guys. If we get a buy signal, we will look at buying more since we are under allocated on this one by at least 10 shares. So I think that's enough to warrant getting back into the company if, there's nothing out there better for us. All right. Southern Copper Company. This is a new position for us. As you can see, we're up almost 10%. Once we get to 10%, it will trigger a sell signal. But this is brand new. We've only had this position rather, for a month. And this is all about the metal copper. Okay. The other thing here that I want to mention is inflation, right? Whenever the dollar gets cheaper and things cost more money, then the price of commodities such as metal and milk and bread and those things increase in price. Okay, so with the government printing as much money as they're printing and much more money going into Americans' pockets, you can imagine that the price of things that Americans pay for on a consistent basis are also going to increase in price. And Southern Copper is tied to that price of copper. I may do a graph here in a moment just to show you what that looks like, but so far so good with Southern Copper. Blackstone. Blackstone, as you can see, we're up almost 100% on this company. We purchased it for $36 maybe about a year ago, if not more. It's currently somewhere around $70, $71. So we are way up on this company, and we do have a sell signal. We're just a bit over allocated, just 300 bucks over allocated, which means we have more shares than what the software is asking for. So we may look at selling out its position and getting into something else. I did do an analysis last month on their competitors, and we decided to stay with Blackstone. But I'll look at it again and make a decision. Blackstone is just doing everything right. In the past, I've mentioned here that I've been concerned with their real estate holdings. They're adding to their real estate, but I just finished the earnings call today, and the real estate is only 10% of their total assets under management. So it's not huge. Their life insurance is much more than that. I think real estate is like 60 billion, life insurance is 100 billion, and life insurance is a newer business for them, right? So they have $619 billion under management at the moment. They have about 147 billion that's just sitting in cash, not doing anything. And they're always looking to buy more businesses in order to make more money. Like I said, life insurance is their newest venture. They just purchased a company from Allstate. Their goal right now is to get into they say more perpetual businesses, and what that means is it's just businesses that's going to continually pay a dividend or pay earnings out, every single month, every year, something like life insurance, because all you do is collect the premiums. I mean, that's literally all you do as a life insurance company. You collect premiums, and then of course you have to manage, payouts and things of that nature. But for the most part, you're just collecting premiums and then investing that money back into the market to make sure that you're keeping up with paying out policies and not lose money. So that's what they're doing. They're the best at it. Been doing it for a long time. I did take a look at some of the properties that they just purchased, and they are, higher end properties. So, there's not a, it's not risky, right? Because those persons living in those higher end properties, more or less, will have the money to pay their rent without problem, especially, like I said, with the U.S. government printing as much money as they are. That it's not hard to do, and it's only 10% of their total business. So I'm not so worried about it, but at the same time, we do have a sell signal, so we may look at selling this. All right, so Garmin. As you see, we're slightly up on Garmin, but we are drastically under allocated. All right, and honestly, that was on purpose because we are a little short on cash, and I'll show you what that looks like. We currently have about $2,500 in cash. $1,500 has to stay in the bank, so we're talking about only like $900 extra to do anything with. Of course, if you look at all of our over allocations, you see that we can sort of make that up a little bit to buy more Garmin shares, but not a lot. So we're over allocated about 1,100 there. We're over allocated on Rogers, but we have to keep the cash there and possibly even more later. Okay. You see we're slightly under allocated everywhere else. So Garmin, like I said, is a company that we're going to be drastically under allocated in. I have not, they don't have an earnings call yet, so I haven't gotten in. It's a brand new position for us. But like I said, we're slightly up in that position. So far, so good there. WPC, again, slightly under allocated. The software is calling for 16 shares. We have around 15. So not really a big deal. We are slightly down. Again, I don't have an earnings call for WPC. Maybe it's coming out in the next couple weeks. So next month or next couple months, we'll be able to talk about it. But that's it. WPC, just real estate holding. Don't expect a whole lot from these guys. They're into residential real estate. and it's higher end stuff, and that's about it. Um, our orphan stocks, I've talked about these before. These are stocks where we have just one share apiece. Okay, so these are orphan stocks that we just own. They just sit there and they pay out a dividend. We don't do anything else with them. But we are up on Energy Transfer Partners, um, down on Macarich, which is another real estate company, and Annaly, slightly down, another real estate company. But they just sit there and just pay out dividends for us. That's all that is. I want to talk a little bit about the the market as a whole, and let's see if I can do this. Looking for regression. All right. So this is our regression table. And what this does is it basically back tests and forward tests um, the market with all of our um, stocks that we have in our basket of stocks here. Um, let's back out of that. This is just a bar chart looking at the most recent month performance for each portfolio. You see this month of December, it just went crazy. So it dwarfs January and February. So it's really hard to even look at this, let alone make any real analysis out of it. But the light green you see in the back is for February. And so what we're looking at is what has been working, right? What portfolios have been performing best. I looked at this before I started the video. So I'll tell you right now that right now the beta and dividend stocks are working best. But let's take a look at this though. So the darker green are the better performing stocks. Okay, so we see the dividend portfolio for February is at 4.57. These numbers down here in the yellow are for the 3 months. So this first one is from September to December. This one is from October to January. This one's from November to February. Okay, and this is a total return for these 3 months. All right, and so we see right away that the beta portfolio is or has been the better performer over the last 3 months. And remember, beta means that the companies are performing well when the market is not. Okay, we see dividend beta also performing really well. And again, that just means that we have those companies performing better when the stock market is not doing so great, but it's also paying out a hefty dividend every month as well. And so those dividends really make up for any loss in share price. Just kind of going down the list here. Everything else, let's see, this one is 23%. Uh-oh, let me back up. There we go, 23%, and that one is dividend beta alpha. And so again, it's going to be dividend and beta with a little bit of alpha thrown in. Alpha is, companies that perform better when the market is performing well. So that makes sense. But again, we see the dividend alpha there. And what else? Got 24% is management score, dividend and beta. So again, we see this dividend and beta over and over and over again. That is clearly the portfolio that is performing the best right now. And it's really hard, honestly, I mean, the market has done well. It isn't performing poorly. but it's not flying as high as it did in December for sure. Let's take a look at what those portfolios look like, and we'll come back to the individual performances here in a moment. So there we go. All right. Let's fade it down. Let's go all the way to, there we go. All right. So this is the dividend portfolio. Again, these are the companies in our basket of stocks that have the highest dividend in their respective sector. Okay. So we have industrials, IEP, Annaly, real estate, Telefonica, I believe that is, for communications. CCL, I forget who that is. Magellan Energy, Altria is cigarettes and consumer defensive, BBVA, bank, PPL, TAK, LYB, I forgot what that is, but and then Hewlett Packard for technology. And now the performance of these portfolios that we're looking at are going to be over the course of roughly, let me see, from July to now. So we're talking about 7 months. Okay, it's about 7 months. This portfolio is negative. All right, let's take a look at the beta portfolio. I do want to mention though that in months past, that portfolio was down a lot more than 2%. So it has clearly come up quite a long way. All right, and then our strictly beta portfolio, we have Baker Hughes, TLK, EIX, well, OMC, Campbell Soup. So that's good. So we have a company with great beta in our portfolio right now. Same with Southern Copper. Same with Garmin. So that's really good. So that means that we have some of these great beta plays in our portfolio working for us. So that's good. It's really good to see. And let's see what their performance has been. All right, so it's even. It's just about 1%. Just not great, but not horrible either. And then again, this portfolio was way down before then. Now, currently, the return portfolio has been the better performer over the last 3 years. And so that's the portfolio that we're trying to mimic. And we see that our return is, 32% over that same time period. So, historically, this portfolio has done much better. And so you see Bank of America is the company that the software is calling us to. We're currently in Blackstone. A lot of the reason why is because we were already in Blackstone. Garmin, VLO were there. Fastenal were there. Basic Materials is CE instead of Southern Copper. But based on the fact that the beta portfolios have been performing better as of late, I'm definitely okay with staying in Southern Copper for the time being. Merck, SYY versus Campbell Soup, but again, Campbell Soup is in that beta portfolio, so I can be happy about that. BIP for utilities, Rogers Communication, and UDR for real estate. So we're, almost 100% mimicking this return portfolio. Let's take a look at the dividend and beta portfolio and see what that's doing. And then we'll take a look at all of the portfolios as a whole here in just a moment. Okay, let's go back. All right. Okay, so this is a dividend beta portfolio. Again, it's another great performer over the last couple months, and we see that this portfolio is completely different than what we were just looking at. Telefonica, we said that one before, but ENB is different, FE is different. Annaly is still there because of that huge dividend that Annaly pays out. BBVA is still there. IEP is still there. OMC, Altria is still there. Pfizer, and then Southern Copper again. So again, we have just one company out of this bunch that's in one of those portfolios. So I could be happy with that because again, we're really going after that return portfolio. But the fact that we have a couple companies in the better performing portfolios as of late is pretty cool. All right, what I want to look at is not the right one. Let's see here. Go back here. There we go. All right. So I've talked about this in the past. This is our MVP, all right, most valuable player. And so what happens is every month we calculate the best performing portfolio as far as just return, right? So if one portfolio returns 5% better than all the other portfolios in our basket, then they show up on this list. Okay, so just to give you some reference here, yes, we got March 2020 to February 2021. All right, and so this is the best performing portfolio for March 2020, and these are the companies in that portfolio. All right. And so what we do is we really just come in here and we just count how many times over the last 12 months these companies have shown up on the best performing portfolio. Okay. And this is color coded, as you can see, to make it a little bit easier to ascertain what's what. Over the last 2 months, those beta portfolios have performed best. And so you see some of those same companies that we just mentioned here. And even if I were to go back, the last couple months, we still see some of those same companies here: IEP, Pfizer, Southern Copper, Campbell Soup. So these companies are performing better. These portfolios are performing better. And so that's something to really take a look at because it looks like the market is changing a little bit, right? It's going from more of an alpha return play to more of a dividend beta play. So we'll continue to monitor that. Definitely going to take that into consideration when I'm looking at replacing companies in our portfolio. All right, so now let's take a look at all the portfolios. And what I like to do here is I like to just do a quick sort just to see kind of what's going on. And so this is the last over the last was it 19? Yeah, June 2019 to current. So that's about what, maybe 17 months, I think, or something like that. The best returning portfolio looks like beta return. And we can go back and take a look at last month and see what the difference is too, because I believe that the return standard deviation was actually on top, and now we see that beta return is on top. And what that means is that we're starting to see those beta portfolios really perform better. And even if you just look here, I mean, that's beta, that's beta, that's beta, that's beta, that's beta, that's beta, beta, beta. I mean, my goodness, beta's all over this thing, and so they're in the top 10 for sure. And so that means that, again, we have to start looking at those beta portfolios if we really want to get some good performance here. All right, this is last 12 months. Last 12 months, we see that return is still outperforming everybody in the group. We have beta return alpha, another beta, another beta, another beta, and then more return and alpha. So again, I mean, beta is all over this thing, all over this thing. Okay, so clearly there's a little bit of a shift in the market, and again, we'll definitely take a look at that. Now, the high and the low, this is more just about the deviation, how much these portfolios are jumping around. Like one month they may be way up, next month they may be way down, right? And so there's something that we want to take a look at because we want to try to keep this portfolio as liquid as possible. And what I mean by that is that if we decide on Monday to sell everything, I want to be able to sell everything without losing a lot. Right. And so what that means is that we want to make sure that these portfolios are not jumping around too much. Okay. Now, the return portfolio, as you can see, the lowest has been 18%, the highest has been 16%. And, some of that is just the way the numbers work, right? If you have a higher performing portfolio, it's going to crash at some point too. So something to definitely think about. But alpha return definitely up there at the top as far as highest monthly return. And then um, for the portfolios that don't lose a lot, right? The portfolios that don't lose a lot month to month, you can see are all your beta plays, which makes perfect sense, right? Because that's what beta is about. When the market is doing horrible, these beta companies are doing great, okay? But of course, they don't have such a high return, okay? Nothing even close to 16%. These things are like 9, 8, and this one is 11, another 11. Um, so, that's kind of what you have to deal with. Now, let's take a look at the worst, because I'm curious. So, yeah, there you go. So, alpha return. I mean, it goes hand in hand. The higher the portfolio goes, the lower it's going to go. The lower the portfolio goes, the less higher it goes. It's horrible grammar, but I think that makes sense. All right, let's take a quick look at individual performance. This is going to help me really take a look at which companies I'm going um, to analyze when deciding um, what companies to switch out of. So this is the basic materials. And let me see, am I going to be able to do this? Let's see here. I think, let's see. Okay, there we go. All right, so as we can see, CE is the MVP. That thing has shown up over and over again over the last 12 months. But Southern Copper has the better average over the last 12 months. Let's take a look really quick at the sector itself. And we see as a whole, sector is down every single month. So, any month that we have a company in here that's actually doing well is a company that we really want to take a look at, right? And so we've already looked at Southern Copper as being a great beta play. And so as of right now, it looks like that's where we need to stay. Let's now take a look at the communications. All right, Verizon is the VIP or MVP rather. And it looks like Rogers Communication has the better overall average for the last 12 months. Let's take a look at the sector as a whole. And I don't have a number there. Let's see where my number is. It's gonna show me. I'm gonna have to take this filter off. And actually, I think I saw it on the basic side. I need to move that down. Yeah, there we go. All right, so communications again has been down every single month. It's not gonna let me move it. It's been down every single month as a whole. And so what that means is again, any company in here that has that beta is where we will want to be. And right now we don't have that. TLK and TEF are the better beta plays. But Rogers has been good, and like I said, I think there's a lot of upside there, and they have the better return. So we're going to continue to just keep an eye on it. If we can build our position, if everything stays the same, we'll continue to build our position in Rogers. But if we do need to sell out of it, then we kind of know where we need to go, right? All right, let's take a look now at the consumer cyclicals. Um, Best Buy and Royal Caribbean are tied for pretty much everything. Tied on average return for the last 12 months and also as co-MVPs of the sector. I did do an analysis on these two in Royal Caribbean. The cruise ship industry is just not where we want to be. I'm pretty sure at some point they will see a resurgence, but I think that is a long way off. I don't know if there's any cruises going out at all right now. And if there are, they can't be large in number. When it's going to come back, I don't know. Personally, I've never been on a cruise, so I can't really speak to that, honestly. But I can't. I think that the average, the price performance has really just been people looking for what they call fishing in the bottom of the barrel, right? So looking for companies that's been beat up really, really bad, and then buying them cheap in hopes that they'll climb again. And I think that's evident of this, almost 50% return in December. We looked at that bar chart that showed the returns for all the portfolios in the month of December, and it was crazy. And so we see Royal Caribbean at 43% almost. Had to increase this average by quite a bit. Even when you come down here, you look at CCL, which was on one of the portfolios that we looked at. Even with a 50% price increase in December, their 12-month average is still only 2%. I mean, it's come on. So I think we're good where we are in Best Buy. We do have a sales signal on it, but I'll take a look at this MGA. We'll take a look at MGA and see if maybe there's a possible swap out there. But I do definitely want to give Best Buy at least another month or two, depending on when that earnings call comes out, before we sell out of it. All right, let's take a look now at consumer defensive. This one I'm really excited to see because I really don't know what's going on there. All right, so Campbell Soup is the MVP. No, 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 no. RTX. So, I'm curious. Let me do this. Let me sort this again because I think what's happening here is because the average returns are so crazy, we're getting a weird sort on there. Okay, here we go. Now I just had to resort. Okay. So RTX is the MVP. Campbell Soup, slightly behind. Their return is not great. Target just blowing everybody out of the water. Definitely winners from the COVID stuff, but we can't get back into Target because the price has just gotten way too high, and we can't get into anything more than $150 a share. SYY looks like it's another MVP, really good average return. But we're currently down in Campbell Soup. We can't really do anything with it. We're just gonna have to wait. I don't plan on adding to the position unless we really, really have to. If the price slips too far, then we may look at just selling out of it and getting into something else. But that's kind of where we are there. Um, and we have an error here because of this company down here. This TIF. I'll have to uh, I'll have to get that fixed. I think where'd it go? I think this company may have gone out of business. That's usually what happens when we see this error like this. But either way, as a whole, just to pull out, so we get 3 months here. And let me do it. There we go. All right. Yeah, sector's been kind of up and down. I think on average it's probably up. Let's see. And yeah, it's even. It's at zero. Campbell Soup is that beta play that we were talking about. Again, if the sector's not doing so well, we expect Campbell Soup to do pretty good. All right, let's take a look now at our energy sector. And this was the worst performing sector last year. And so I expect there to be a resurgence this year in energy. One thing to mention here, I didn't say it at the beginning, but Valero is saying that the recyclable diesel fuel that they're creating, they can also make into aviation fuel if they need to. They say that there's a difference, of course, but it's not a huge difference. So if they need to make that pivot, they can make that pivot. And so, I mean, we're definitely going to see aviation come back. We're definitely going to see gasoline sales come back from people driving. I mean, it's going to happen. It's just a matter of when, you know. But either way, as you can see, it is the sector MVP. It's been all over the place in almost every portfolio we were looking at. And the return average is, again, not spectacular, but not horrible either. And let's take a look at the sector itself. I'm curious to see where it's been. And so this one we're going to have to pull down as well. See here. Where is it? There we go. All right. Wow. Yeah, I didn't expect that. Yeah, it's the sector as a whole has been down. So we'll see what happens. Hasn't done much of anything, and but like I said, we're up right now, so I don't have anything to complain about. We'll just keep monitoring it and see where we are. All right. Financial sector, DFS is not only the sector MVP, but also has the better average. So I'm definitely going to be looking at DFS, Bank of America, and Blackstone as a potential swap out. Well, DFS and Bank of America as a potential swap out for Blackstone. We've been in Blackstone for quite some time, like the position, but if we can, get a better return somewhere else, then we're definitely gonna look at doing that. All right, and let's just see what the sector is doing. I think all of these are maybe off by one. And it's got to be that company that just went out of business, the TIF, whoever that is. Let's see. Go up, down a little bit. Yeah, so it's off by one. All right. So, oh my goodness. I mean, just everyone. Look at this. Every sector, almost every sector is down. Um, I mean, I think that says a lot to why the beta portfolios are performing so well. So I think BBVA, yeah, BBVA had the highest beta, and not a bad average return either, but just hasn't made the best performing portfolio somehow. I don't know how that happens, but it's like, let's see, HIG, HIG is actually, yeah, HIG is actually the sector MVP. Let's see what happens when I resort. For some reason, I think it's unsorting every time I filter out. Yeah. So there we go. So HIG, uh, sector MVP, um, but not such a great average return. Maybe that's changing now. We see some pretty big gains over the last couple months. Bank of America is right there. All right. And so, yeah. So we'll look at DFS, we'll look at Bank of America and compare it to Blackstone and see if maybe it's time for us to sell for a profit on Blackstone. All right, let's take a look now. Healthcare. And healthcare is interesting just because of COVID. There's the COVID players, and then there's not the COVID players. Excuse me. And so here we go. So Medtronic sector MVP. We've looked at this and talked about this previously. Pfizer and Merck are really tied in that respect. And see, everyone else is about the same. Let's take a look now at the sector as a whole. As you can see, again, down, 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 down. Yeah, almost even, right at zero. So, none of these sectors are doing horribly, but they're not doing just great either as a whole. So we're a little down in Merck, but we're going to stick around and see where it goes. Um, they'll have Keytruda for quite some time. Let's take a look at industrials. All right, let's sort this thing again. All right, industrials. All right, so IEP is the sector MVP. We've discussed them before. Eden and then Fastenal. Of course, Fastenal has better average return, and then Johnson Controls is kind of right there with them, slightly over. Let's take a look at our sector average. And again, as a whole, it's going to be, yeah, negative 0.64. So it's at zero. Almost every sector right now is at zero. Not doing great, not doing horrible. But Fastenal is a new position, slightly down. We're going to stick around for a little while, see where it goes. So now we got real estate. Real estate has not been a great sector for quite some time now. I think it's going to take, some economic boom to really get real estate going. But you have to have it, right? You have to have it. It's not going anywhere. And WPC, where we are now, is the sector MVP. Looks like DRE, which I've talked about before, is a really interesting company dealing primarily. Let me make sure I'm right about this. DRE, yeah, dealing primarily with servers, server farms. So companies that own servers, they have to house them somewhere, and so DRE provides that space for that. And so they've always done really well. Annaly, which is something I always keep my eye on because I really like the company. They're more of a bank mortgage company than they are a real estate company, honestly. And their average return over the last 12 months has been awesome. They pay a really big dividend, but um, they are not a beta play. They're strictly a dividend play. And so I feel like that those 10 shares that we have as an orphan position, I think is good enough just to make some dividends. But we don't necessarily need to be investing in a company. WPC has, of course, been on the better performing portfolios over the last 12 months. So that's where we'll stay, at least for a little while. Again, it's a new position for us. So just let's take a look real quick at the sector as a whole. I don't expect anything to be different here at all. And yeah, so again, average is 0.47. So like all these sectors are like right at zero. All right, let's take a look now at technology. Again, just want to preface this by saying we are very under allocated in Garmin, and that's primarily due to us being over allocated on some of the other positions that we have. I do expect to have some more cash coming in a couple months, and so if the price of Garmin is good, then we may look to adding more to that position just to bring us up to to even on allocation. But you see here, Hewlett Packard is the sector MVP, Garmin close second, and then they're both about tied for the average return. Qualcomm is a company that I have followed, for probably the last 10 or 15 years. I did an analysis on Qualcomm back in college, and that was really my not my introduction to Qualcomm, because I had followed them before that, but it was my first deep dive into Qualcomm, and so I got a chance to learn a lot about the company, and so I've always kind of kept my eye on them, and I'm really shocked to see their average return over the last 12 months be all the way up to 6%. I mean, they are just killing the rest of the sector in that regard. But again, they're not making any of the portfolios that I can see. So I'm not sure kind of where they are, honestly. But their prices obviously are doing really well. Now, I expect the technology sector to actually be up a little bit because they did so well last year. Last year we were in Texas Instruments, and before that we were in I forget. We were in another technology company. Either way, big tech was just booming last year, and so we made a lot of money there. But yeah, just recently though, they haven't been doing much. No one's really talking about big tech, and I have not had an earnings call yet on Garmin, but I am really interested into getting into it. Garmin just purchased another satellite company. They're just an industry stalwart. I mean, my goodness. Garmin, I believe, is like the leader. There's a few other smaller companies that compete with Garmin, but Garmin is the one. When you talk about satellite GPS, when you talk about, hiking and boating and all these things where you're in these far off places without a cell phone signal and you need to have a map to know where you're going, Garmin is where you want to go. They have maps for almost every country and lake and ocean that you can think of, and it's all downloaded, all for download online to their devices. I've had a Garmin device myself for many, 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 many years. That thing has been dropped and everything else. It's been in my glove box, in my car, in 100-degree heat in Texas, and it still works. So I have a lot of positive things to say about Garmin. Again, I'm really looking forward to getting into the earnings call, and we're currently, like I said, slightly up on the position, so that's great. Being that we're so under allocated, I definitely don't want to miss out on any great price appreciation because of that, but it is what it is. We have to manage our cash. All right, let's take a look at utilities. See where we are there. Da-da-da. All right, utilities. Got to sort again. All right. All right. So, yeah, Edison is the sector MVP here. Um, and these utilities are pretty spread out as far as what portfolios are performing the best. I remember seeing FE on one of the beta portfolios. So that's interesting. BIP, I believe, was on one of the dividend or beta portfolios. And I remember seeing one other, PPL. Yeah. So, um, but it hasn't been an MVP. That's interesting. So anyway, we're currently in Excel Energy, not doing great as far as average return, but not doing horrible either. And just to kind of look at things, FE, like I said, was on one of those better performing portfolios, but look at the average returns. It's horrible. Last couple months looks like it's had a really nice run compared to Excel Energy. So there may be something to be said about that. But again, it's a brand new position for us. I really like the company, and so we're definitely going to give them a chance. They just increased their dividends, so that's always good. Let's take a look at the sector as a whole. For utilities, I actually expect the sector to be positive. Software is freezing up. Let's see here. I expect them to be positive, and it looks like they're going to be about even, just like everybody else. There we go. Yeah, yeah, it's even like everybody else, negative 0.1%. So, yeah, I mean that's interesting. We're having a really cold winter, so if those revenues aren't really cranking up now because we've kind of gotten past the moratorium on the COVID utility bills, I believe in a lot of places. I know up north still has, those government mandated, if it's below a certain temperature, you don't have to pay your bill type of thing. But I imagine though, on that first quarter earnings call in March and April, I imagine we're going to see some weather related increases in revenue and fees. And so I think Excel Energy is in a really good place to make that happen, specifically because of where they operate, right? Um, so let's take a look, see if I can do this. I don't think I can. Let's see here. Because we are halfway through our fiscal year, I want to do a quick comparison with our benchmarks just to see where we are. Mm, And see. I'm looking for the chart. And I tell you, over the years, they have made it harder and harder um, to get access to just financial data because they want you to pay for they want you to pay for data, which I understand, and I do pay for data. Um, but for but for simple like, what has the Dow done for the last, 6 or 7 months? That information, I mean, as far as I'm concerned, is free. It's no different than, I don't know, like the news, right? But, not my it's not my place to say. I just remember it being a lot. Um, I remember it being free. It's not free anymore. All right. Going to have to do a comparison, I guess, in order to really see this. And then let's blow this up. All right. Am I still at 6 months? Okay. And we're at 6 months. Okay. So we see here the Dow at 11%. And a lot of that has to do with this big increase that we see here from, yeah, way down in November and then just skyrocketed up uh, in December and in January. So 11%. Right now, we're currently at 3%. So we are in danger of not beating our benchmark this year. But we still have another 6 months to go. So we're gonna keep going. If the Dow is at 11, there's no reason why we can't be at 11 as well. So we were out of the market for most of our fiscal year, which started in July. We didn't make any moves whatsoever until January of 2021, just because I didn't want any parts of the up and down and craziness that COVID brought along. Just not knowing, how the economy was going to be affected. I just stayed out of it. And so we didn't enter the market really until January. Our positions were just our positions, and I just let them sit there. We didn't get a chance to get that big, huge rush that happened in December. But again, we have another 6 months, so we'll keep going and see where we get to. Was there anything else? I wanted to look at the price of copper. Just gonna see if we can quickly do a comparison. This thing is really slow while I'm recording. All right, I'm gonna compare. Not the minors. We want the futures, and I just saw it. It's not there. for futures. Oh yeah, this thing is like it's frozen. I'm asking it to do too much. Yeah. Yeah, I'm just asking it to do too much. It's not gonna work for us. Either way, that's it. That's the market as a whole. That's our portfolio right now. See you next time.